capisce un cazzo cosa pare di bene.
咱又坐那么后边，好，一会儿见。
Okay, good afternoon. Students here in the classroom, not so many students today because it's Friday. And students that are at home, now the number is growing. Today we continue with the business combination. Yesterday, and now it's right to say yesterday, we discussed at the end of the lecture the business combination, that is M&A in general. So when a company acquires control over another entity. And we discussed the fact that under IFRS there is a specific standard, which is IFRS 3, that obliges the company to use the so-called acquisition method in order to account for a business combination. According to the acquisition method, it is necessary to, first of all, to identify the acquirer, that is, who buys who. So the company, the group that acquires the control, and the acquisition date. That is, it is necessary to clearly define the date starting from that date the control is transferred from the seller to the acquirer. The identification of the acquisition date is very important because starting from that day, the assets and the liability of the acquiree are recognized in the accounting books of the acquirer. Moreover, we will verify in a few minutes that the initial recognition of the assets and liabilities in the acquired financial statements must be done at the fair value at the acquisition date. So the identification of the acquired and the identification of the acquisition date are two very important steps in our exercises. To be honest, it is always very simple to identify the acquired and to identify the acquisition date. But in real cases, this could be a little bit more difficult. Yesterday, I asked you, to have a look at the merge between FCA, PSA, and so the new company that is called Stellantis. This is the FCA financial statements at the end of 2020. But the same information is reported also in the PSA financial statements. And if we go to page 310, it's yes, with the subsequent events. 310. This is the note 31. That is named subsequent events. So this is the financial statements at the end of December 2020. And in this part of the notes, FCA disclosed events after the end of the reporting period. And as you can imagine, the very important event happened after the end of the reporting period, but before March the 4th, that is the date when the board of directors approved the draft of financial statements. It's of course the merge of PSA and FCA. In the first part, you can read a sort of summary of the most important facts related to the merge. The merge is that the agreement was signed at the end of 2019. Then in September 2020, the agreement was amended. And on January 2021, the two shareholder meetings had place and approved the merger transaction. So on January the 17th, the combined company was renamed Stellantis. The board of directors was appointed, and the article of association of the new company became effective. So starting from this date, the Stellantis management and board of directors obtained the power and the ability to control the asset, liabilities, and operations of both FCA and PSA. So under IFRS 3, this is the acquisition date. Okay? So PSA and FCA, they merged. This is a business combination. And the acquisition date is January the 17th, 2021. Is this clear for everybody? Then, identification of the accounting acquired. This acquisition is a quite complex acquisition. So also the identification of the acquired was not so easy. And in fact, from a legal point of view, the surviving legal entity was FCA, then renamed Stellantis. So this means that the shareholders of PSA, the shares of PSA were cancelled, and the shareholders of PSA received shares of FCA. Is this clear for everybody? But they acquired from an accounting point of view. As you can read, the merger will be accounted for by Stellantis using the acquisition method, the method that we have just started to discuss and to understand. And it is necessary to identify the acquirer and the acquiree. PSA and FCA analyze the standard and they look at the indicators under IFRS 3. And look, PSA has been identified as the acquirer. So from an accounting point of view, FCA and PSA management determine that PSA is the acquirer for accounting purposes. Is this clear for everybody? So it's more complex than our exercises, okay? Because here the surviving entity was FCA, that renamed Stellantis. But from an accounting point of view, the acquirer is not FCA, but PSA. Keep in mind that the acquirer is the company that acquires the control over the other company. And here, composition of the board of directors. 11 directors, 6 of whom nominated by PSA shareholders or PSA employees, or they are current executive of PSA. So this means 6 for PSA, 5 for FCA. Moreover, the first CEO is the former president of PSA. And looking at the amount paid, there has been a payment of a premium by a pre-merger shareholders of PSA. So the PSA shareholders, they received a sort of premium. So this is a very particular situation because in normal situation, the legal entity that survives is the acquirer. Intesa Sanpaolo merged UBI. Intesa Sanpaolo, that is the surviving entity, was also the acquirer. Here, it's completely different. Even if from a legal point of view, the surviving entity was FCA, then renamed Stellantis, the acquirer is PSA. For this reason, here you can read that here, okay, from an accounting point of view, this has been recognized as a sort of reverse acquisition, because it's not FCA that acquired the control, but PSA that acquired the control. If you are interested, you can read the part that refers to the consideration, so the amount paid. From my point of view, since this is quite complex, what is important is the final result. Here. Okay? Final result is this one. PSA paid, not in cash, of course, this is just a change of shares, 19.8 billion in order to buy FCA. Okay? Keep in mind this number, 19.8 billion paid by PSA in order to acquire FCA.
I have a question. So,
Yeah.
what's the reason behind this kind of merger when the PSA just acquired the FCA? But this is the FCA who got the name and reserved the name and then changed it into the Stellantis.
FCA was listed also at the New York Stock Exchange.
Yes.
So for legal reasons, FCA is based on the headquarters is based in Netherlands. So from jurisdiction reasons, it was better to maintain FCA. But looking at, and this is the form, but looking at the substance, is PSA that acquired the control over FCA.
Yes.
Reasons are mainly linked to the fact that PSA was listed also the New York Stock Exchange, that PSA has the headquarters in Netherlands. So from a formal point of view, it was better to maintain the legal entity FCA. The change of name, of course, because here is not like in Intesa San Paolo that acquired the control of the UBI. Here is a merge of two companies that more or less they have the same size, even if not exactly. And so, in order to start a new project, they decide to change the name.
Thank you.
You're welcome.
Professor, what is the meaning of consideration transferred?
Consideration transferred means the amount paid, but consideration is a general word that is the amount for something, that you pay for something. You pay a consideration in order to buy a bottle of water is 2 euros. The consideration, so the amount paid in order to acquire FCA is 19.8 billion.
So it's PSA paid 19 billion to acquire FCA.
Exactly. But not in cash,
Okay.
because this has been a merge. So this is not an amount of cash from PSA to the shareholders of FCA. This is a result of a very complex computation, but at the end, this is the amount paid by shares in order to acquire the control over FCA. Okay? And if everything is clear, I don't know if there are some questions also from students that are at home. Now there are 57 students connected. Otherwise, we can go to the slide and look again at the acquisition method. So, identification of the acquirer, determination of the acquisition date. Now, third step, very important, the recognition of assets acquired, liabilities assumed, and non-controlling interest. Right now, do not focus on non-controlling interest. By the end of the lecture, we will understand the meaning. Okay? And yesterday, the last slide, if I'm not wrong, was this one, the slide number 9. Okay? At the acquisition date, it is necessary to identify, pay attention, this is very, very, very important, the acquiree, okay? So we are the acquired, we are Intesa San Paolo, and we need to identify all the assets and liabilities of UBI, that is the acquiree, because the acquirer has to recognize the assets and the liabilities of the acquiree in its financial statements. The initial recognition of these assets and liabilities is done at the fair value of these assets and liabilities at the acquisition date. This process is a very long process. It's called, as we discussed yesterday, purchase price allocation, PPA. And it's a long process because it is necessary to identify all the assets and all the liabilities, and then it is necessary to determine the fair value of each asset, each liability of the acquiree. We are not talking of a small company. We are talking of UBI. We are talking of FCA. Very complex group. And as you can imagine, the measurement of the fair value of all these assets and liabilities takes a lot of time. For this reason, even if it is not written in the slide, but it is interesting for you, the acquirer has 12 months of time, starting from the acquisition day, in order to finish, to complete the purchase price allocation. So the purchase price allocation is a process that is so complex that IFRS 3 allows the company to use 12 months. Okay? So this means that Stellantis has 12 months starting from January the 17th, 2021, so until January 17th, 2022, in order to complete the purchase price allocation. Okay? What is the problem? Problem is that in the acquirees balance sheet at the acquisition date, assets and liabilities, they are presented at their book value. During these 2 weeks, we have analyzed the accounting measurement of a lot of assets and liabilities. Property, plant and equipment at cost using the cost method. Intangible assets, cost method. We verify that under IFRS it is forbidden to recognize the internally generated brands. You will analyze also with Professor Esatta inventories, but again, inventories are measured at cost. So the difference between assets in the balance sheet, liabilities in the balance sheet, is the equity at net book value because this is the value in the balance sheet, so in the accounting books of the company. Keep in mind, this is not the economic value of the company. For many reasons. First of all, because assets are not measured at the fair value. In the balance sheet, assets are measured at cost less accumulated depreciation, cost for the inventories, and internally generated brands are not recognized, and so on. Is this clear for everybody? But suppose that in the asset of this company there is a building. The building is located, for example, in Milan, via Monte Napoleone, so downtown Milan. The building was acquired 25 years ago. So the cost paid 25 years ago is far from the market value of that building today. In Milan, we are talking, okay? Moreover, not only the cost is completely different, but the building in the balance sheet is not presented at the cost, but the cost minus 25 years of depreciation. So as you can imagine here, in the asset side, the building is presented at its net carrying amount. It is completely different compared to its market value, compared to its fair value. But if you are the seller, not the buyer, the seller, and if you want to sell this company that has a building located in Via Monte Napoleone, in the balance sheet, the building is exposed at 10. But maybe the fair value of that building is not 10, but 100. Okay? If you are the seller, for sure, you don't accept to sell this company at the amount of the equity shown in the balance sheet. Because you say to the buyer, you have to pay the fact that that building has a fair value that is greater, higher than its carrying amount. Is this clear for everybody? Now, suppose that this company is Ferrero. I hope you remember, I repeated some minutes ago, that the internally generated brands cannot be recognized. But if you want to buy a company that has very well-known brands internally generated, in this case here, the value of the brand is 0. But again, if you are the seller, you don't accept an evaluation of 0. But maybe, I don't know, 400 or whatever. Is this clear for everybody? So, the measurement at fair value of assets and liabilities acquired is very, very important, because in the balance sheet of the acquiree, assets and liabilities, but the problem is mainly for assets, are presented at carrying amounts. But the carrying amount can be completely different, and in most of the cases, it is lower than the fair value of the asset. So the first important things that the acquirer has to do is to measure the assets and the liabilities acquired at their fair value at the acquisition date, in order to re-express the amount of the equity using the fair value of assets and liabilities. With our figures, okay, as you can see, there is a difference of 90 because of the building, and the difference of 500 because of the rent. So this means that the difference between the equity at its book value and the equity at fair value is 590. Is this clear for everybody? So this means that this part, the assets and the liability difference, of course, so equity of the acquiree, if we consider the assets at their fair value, is higher of 590 euros, thousand, millions, whatever you want, compared to the net book value. Is this clear for everybody? Because when you buy a company, you pay the fair value of the assets. And if this is different compared to the carrying amount, of course, you need to identify these differences at the acquisition date. The two typical examples of situations where fair value and book value carrying amount are different are buildings and intangible assets, like brands and other intangible assets. Okay? The consideration paid, so the amount paid, can be paid in cash, and this is what we do in our exercises, but can be paid also in other form. In case of both, in case of São Paulo and UBI merge and PSA FCA, the consideration was paid through equity instruments, through exchange of shares. In our exercise, we simply consider the payment in cash. Okay? Then, now we have all the data in order to account for the transaction. And in order to verify if there is a goodwill, we need to compare the equity of the acquiree, but pay attention, the equity at its fair value, not the book value, not the amount in the balance sheet of the acquiree, but the difference of the fair value of assets and liabilities at the acquisition date. We need to compare this amount to the consideration paid. Go back. Okay. Suppose that the equity net book value 200. Okay? If there is a difference of 590, how much is the fair value in net assets of the acquiree? How much is? 790. Okay? So here we have an amount of assets at fair value minus liabilities at fair value equal to 790. This is the purchase price allocation. We have allocate to the assets and liabilities part of the price. The price is the consideration paid. Suppose that the price is 800. Okay? So you paid 800 in order to buy a company with an equity book value of 200. But through the purchase price allocation, you identified a building with a higher fair value. You identified brands and other intangible assets that were not recognized, but they have a fair value of 500. So at the end, you pay 800 in order to buy assets and liabilities that at fair value, they have a value, fair value in net assets equal to equity, so the equity at fair value of 790. The difference is the part that you cannot allocate to any other assets. Because buildings, inventories, plants, intangible assets, you have measured everything at fair value. There is a difference that you are not able to attribute to anything else. This difference is goodwill. Okay? So, repeat again. We have a book value of 200. We re-express everything at fair value. And so we have a fair value in net asset that is equal to 790. We paid 800. The difference that we are not able to allocate to anything else is goodwill. Goodwill is a residual value from an accounting point of view. Goodwill is never determined standalone. You start from the price paid, the consideration paid, you allocate the price to the single assets and liabilities through the measurement at fair value at the acquisition date. If something is not allocated, this is goodwill. Goodwill is paid because of future synergies, increasing profitability, and so on. There are many reasons. Sometimes you accept to pay goodwill simply because you want to eliminate a competitor, for example. From an accounting point of view, it is not necessary to clearly understand reasons for paying goodwill, because goodwill is a residual value. Is this clear for everybody? Any questions? It could happen, but it is not so frequent. It could happen also the opposite situation. So when you pay less than the fair value net asset. So if we use our figures, 200 was the equity book value, 790 the fair value of the assets and liability. Suppose that you pay only 750. This is strange, okay? Because this means that you pay the company, the business acquired, less than the value of the single assets and liabilities. This is strange. So strange, if I go back to the previous slide, that IFRS 3 asks the company to be sure of this. So please, repeat the process. Are you sure that you have measured in the appropriate way everything? If the verifying again all the figures. This difference is maintained, so the company has to recognize a so-called bargain purchase. Bargain purchase, they have bargain, the gains can have a lot of reasons. Maybe it's really a bargain. So we, as the acquirer, we are very happy in this case. But as you can imagine, if you are happy, the other party is not. Maybe you made a bargain, and so it is not a so good deal for the other party. This could happen, in particular when the other party needs money quickly. But in most of the cases, this is not the reason. If you accept to pay 750 in order to acquire, not if you accept, if the other party accepts to obtain 750 when the fair value of the assets and liabilities is 790, probably it's because the seller is aware that you, as the buyer, you have to intervene. Maybe there is an expectation of future losses. You need to reorganize the entity. And so you say, okay, the value is 790. I don't want to pay, I'm not available to pay 790 because I know that once I have bought the business, I need to invest in order to reorganize, to restructure. I have an expectation of 2-3 years of losses, so I don't pay 790. Okay? This is the most common reasons for a situation like this. But irrespective of the reason, it doesn't matter the reason, under IFRS, in a situation like this, 40 is a bargain, a gain that is immediately recognized in the income statement. So, if there is a goodwill, the acquirer must not explain reasons for goodwill. Goodwill is recognized as an intangible asset in the balance sheet. Nothing else to do. On the other hand, if there is a bargain, or to be more precise, if there is the opposite situation, 40 is recognized as a gain in the income statement. It doesn't matter the origin, a real bargain or expectation of future losses. It doesn't matter. It's a gain in the income statement. Is this clear for everybody? Any questions? Gain immediately recognized in the income statement in the profit and loss. On the other hand, goodwill is recognized as an asset. Keep in mind that goodwill is never amortized, but goodwill must be allocated to the cash generating unit and then tested annually for impairment. Is this clear for everybody? Because if everything is clear, we can immediately apply everything to an example. Then, after the example, we will read together the semi-annual report of Stellantis, where we can find some disclosure about the purchase price allocation. But In my opinion, it's better to try to apply to a simpler case and then to read FCA. Okay? So suppose that on January the 1st, year 1, our exercises is now January the 17th, January the 1st, just to simplify. So, on January the 1st, year 1, the company A acquires a business, in particular the business B. Okay? And, of course, company A paid an amount, so we need to identify the consideration paid, that is the purchase price, that in our example was paid in cash, just to simplify everything. And suppose that the purchase price, the consideration paid, is 1,000. This is a business combination. So, since this is a business combination, we need to apply IFRS 3, okay? And we need to apply the acquisition method, okay? So, we need to first identify the acquired. Here it is a simple job. It's A that is buying B. Second, identify the acquisition date. Again, here it's a simple job. 1st of January, year 1. Okay? Third, we need to recognize the acquiree, in our case means B, assets and liabilities at their fair value at the acquisition date. And in our case, the acquisition date is 1st of January, year 1. Is this clear for everybody? So we need to understand what we have just bought. And so we start from the balance sheet of B at the acquisition date. That in our specific case is 1st of January, year 1. And just to simplify, I wrote the assets and then the liabilities, just using a single column just to simplify the presentation. Then, in the balance sheet, so book value 0. Then, for example, property 800. Oh, sorry. Property 100. Okay. Then, suppose all the other assets, here we have plant, inventories, other intangible assets, trade receivable. I don't want in this exercise to list all the assets, so generic other assets. For example, for an amount of 2,000. Okay? So this means that the total assets is equal to 2,100. This is the amount shown in the balance sheet of B. B has also some liabilities. I don't want to distinguish all the liabilities, but here are liabilities, for example, towards suppliers, toward employees. In some cases, the acquirer decides to acquire also debts, financial debts, but it depends on the single situation. And suppose 1,500.
But it must be clear for the acquirer about the liabilities, because they want to know what they are going to face.
Of course, but not only for the assets, but also for the, not only for the liability, but also for the assets. In fact, before closing the agreement, it is normal to have a long period of negotiation, and during this long period of negotiation, a particular process that is called due diligence is conducted. The due diligence is an accounting due diligence, legal due diligence, tax due diligence, environmental due diligence. This means that the seller must share with the buyer a lot of documents in order to allow the buyer to understand what the buyer is buying. So the liabilities, it is clear in the agreement if the financial debts are included or not. Suppose they are not, but also for trade payables, you want to understand what type of payables you have. Trade receivable, inventories, property, okay? So the due diligence is a very important, there are two items, just one, of course. It's a very important process, difficult process, because it is conducted before being the new company that controls. So it's difficult because on the one hand, the buyer would like to know everything before the closing. On the other hand, the seller is okay, but only if this is a binding offer. So only if you are obliged to buy. Otherwise, I share with you information that can be sensitive. So it's a very long, delicate process, and for these reasons, a lot of consultants and advisors are involved in the process. I don't know if this is very important. It's not from an accounting point of view, of course, but from another point of view. But anyway, I can assure you that even if you conduct a very long, deep due diligence, only once you become the new, only once you enter in B, only at that time you realize what you bought. Okay? This is for sure. So some surprises are always there. Always. I don't know if it is clear for everybody, because it's impossible. Impossible. The right job is to be sure not to understand the big problems in terms of litigations, for example, in terms of responsibility towards customers and suppliers, in terms of environmental risks, for example. So this is the difficult part. So, if we compute the equity, the B has an equity in its balance sheet equal to 600. Okay? Is this clear for everybody? Now, we know that we have to apply the purchase price allocation. Purchase price allocation means that we need to identify the fair value of the assets and of the liabilities acquired. So we need to measure the fair value of the brand, the fair value of the property, fair value of the other assets, fair value of the liabilities. And suppose that the fair value of the brand is 300. The fair value of the property is 150. The fair value of the other asset is 2,000, exactly equal to the book value carrying amount, whatever, it's the same. So this means that the assets, if we look at them not using the book value but the fair value, they are equal to 2,450. Suppose that the fair value of the liability is exactly equal to the carrying amount. So this means that if we re-express the equity of B at its fair value, we find 950. Okay? This 950 is the fair value in net assets. Okay? Is this clear? Look, please, because for the exercises we can give you the information in many different ways. Okay? We can give you the fair value, the assets and liabilities, or we can give you simply the difference between the fair value and the book value. 350. Okay? So, we can give you the value of the brand, the value of the property, or we can say the book value of the equity is 600, but pay attention that there is a brand that is not recognized that has a fair value of 300, and there is a property with a difference between the fair value and the book value of 50. As you can see, you can obtain 950 also by starting from the book value of the equity and adding the difference between the fair value and the book value of the brand and the property. Is this clear? So just to highlight that what is important is to determine this 950. And it is possible to do this in many different ways. It's up to you if you have quality data, or it depends on the data that we provide. Okay? Now we need to compare the consideration paid and the fair value in net assets. The consideration paid is 1,000. The fair value in net asset is 950. Okay? So in this case, we have a goodwill. Goodwill. That is the difference. Is this clear for everybody? Goodwill is not amortized, it is necessary to allocate to the cash generating units, one or more than one, it depends on what we have both. It is not amortized, and it must be tested for impairment at least once a year. Okay? Is this clear? This is the information about B. That is the acquiree. Suppose that we have also the information of the balance sheet of A at the acquisition date, so 1st of January, year 1, but before the acquisition. Okay? Before the acquisition. So before the acquisition, suppose that the company A has a property of, suppose, 800, cash, suppose of 1,200. So total assets 2,000. Then A has some liability, for example 300. So the equity of A is 1,700. Of course, these are my hypotheses. Is this clear? Now, we made the double entry record that A has to do in order to recognize the new business acquired. Okay? So these are the double entry records. So on 1st of January, year 1, to recognize in A's accounting books the new business B. Okay? And maybe you can help me. Here you have all the information. So we are A. We buy and so we pay. We buy a business. We need to pay and we need to recognize the assets and the liability of the acquiree at their fair value. So, please help me. Any idea about that? My suggestion is always to start from the cash movement. We pay 1,000. Okay? So double entry. We have an outflow of cash, credit side for 1,000. Then we are buying not a single asset. We are buying an entity that has assets and liabilities. So we need to recognize the single assets and the single liability. So the brand, property, and other assets. Is this clear for everybody? If I buy the entity, I buy the assets of the entity. So I need to recognize in the debit side the brand, but at its fair value at the acquisition date, 300. I recognize the property of B, but of course the property is recognized again at its fair value at the acquisition date, 150. Then there are all the other assets. Assets, again, debit, 2000. Do you agree? But when we buy B, we buy also liabilities. So we need to recognize the liabilities. And again, liabilities are recognized at fair value, but in this case, there are no differences. 1,500. Does it match or not?
Goodwill.
We need to recognize also goodwill. And the goodwill is 50. Now, if we check, debit 2,500, credit 2,500. Okay? This is the recognition of in the A's accounting books of the new business being acquired. This is a very particular type of acquisition because it's paid in cash, and A has acquired the single assets and the single liabilities of B. It's not the only way of acquiring the control over another company. Is this clear for everybody? So, this is the balance sheet of A before the acquisition. On January the 1st, 1 second after the acquisition, of course, we need to consider the new assets and the new liabilities acquired. Pay attention, this is very important. As you can see, only the assets and the liability of the acquiree of B are measured at fair value. Goodwill is recognized only having regard B. A is the acquirer, and the assets and liability of A, the original one, they remain at their book value, at their carrying amount. They are not adjusted. The acquisition method implies that only assets and liabilities of the acquiree are remeasured at the fair value at the acquisition date. Assets and liabilities of A, that is the acquirer, they remain at their book value. So after the acquisition, look, it is necessary to recognize brand, of course, goodwill, and so the brand is only the brand acquired, 300. Goodwill is 50 paid on the acquisition. What about the amount of property? How much is the property in the balance sheet of A 1 second after the acquisition? Is 800, thank you Valentina, plus property of B, but property of A are at the book value. Property of B are measured at the fair value at the acquisition date. Cash, after the acquisition, the cash is no longer 1,200 because the company has paid. Thank you, Viola. The cash is now 200. So total assets 1,500. Liability are the liability of A plus at the beginning the liability of B, 1,500 as suggested by Valentina. So now the equity is
Other assets.
yes, okay. There was something missing because okay, thank you very much. Other assets. I have everything here, but I was not looking because when the figures are using Excel, it's quite common to lose something. The other assets are 0 plus 2,000. And so total assets 3,500, now it works, and the equity the same. Why the same? Because at the acquisition date, 1 second after the acquisition, there are no impact on the equity of A. Look, simply A has 1,000 in cash. Now, this 1,000 in cash is substituted by assets and liabilities of B, with no impact on the equity at the acquisition date. Is this clear for everybody? Any questions? This is your first merge and acquisition accounting. Very simple, but it's exactly the same mechanism adopted by Intesa Sanpaolo in order to recognize the UBI assets and liability, and it's exactly the same process that Stellantis is now managing in order to recognize MCA assets and liability. Okay, there is a question from Claudio. Yes, we sum up the A book values and assets and liabilities with B fair values for each single item of the balance sheet. Pay attention, of course, that this is just in order to have an idea of what happens on 1st of January, year 1. Then, starting from the 2nd of January, year 1, in this particular case, there are no distinction between A and B because now everything is within A. Okay? This is just the starting point. $800, Sophia, is the carrying amount. So the carrying amount here, I just do the carrying amount is always the historical cost minus the accumulated depreciation minus, if any, the accumulated impairment losses. Okay, so this is the carrying amount, book value. So of course, net of the accumulated depreciation. Other questions? Okay. Go to Stellantis. Semi-annual. Before going to the semi-annual, I would like to go back. This is the FCA financial statement. Before going there, the sheet of here. Okay. Because I'm stubborn, so I know that it must work. Must work. This is the balance sheet of FCA. Okay. The acquisition date is 17th of January 2021. This is the balance sheet at the end of 2020. So 17 days of difference. Peanuts. Do you agree? Because this is at the end of December 2020. The acquisition date is on the 17th of January 2021. So only 17 days of difference. Okay? So PSA paid 19 million or something like this in order to buy FCA. The equity of FCA was 25 billion, then there was an extraordinary distribution of dividends, so the equity was increased. If we go to the semi-annual, and in particular page 63, you can see this is the semi-annual at the end of June 2021. Okay? The first part is a copy and paste. It's exactly what we have just read. Okay? Here, there are some other disclosures about the strategic reasons for the business combination. So, new industry leader, a greater geographic balance, stronger platform for innovation, synergies. Okay, so these are the objective in terms of strategy in the medium term. Then the identification of the accounting acquired, copy and paste of what we have just read. As for the consideration transferred, okay, and here, consideration transfer 19.8 billion. Okay, then look, consideration transferred 19.8 billion. Don't consider minorities right now, less preliminary fair value of FCA's net assets acquired. I hope that you can see the similarities with our exercise. Okay? So in our exercise, 1,000 is the consideration transferred. 950 is the fair value in the net assets. Okay? For Stellantis, 19.8 the consideration transferred. Preliminary, because Stellantis has 12 months, so until January 2022, in order to complete the purchase price allocation. So the preliminary fair value is 8.5, so a goodwill of 11.3 billion. This is clear? And here there is the description of the purchase price allocation, purchase accounting, and as you can see, as you can read, as the assets acquired and the liabilities assumed in the business combination are recognized at their fair value at the acquisition date. The excess of the consideration paid compared to the fair value net asset is goodwill. Read this other part in green. PSA is the acquirer, FCA is the acquiree. So PSA assets and liabilities, together with all the operation of PSA, will continue to be recorded at their pre-merger historical carrying amount for all periods. They are not changed. And that amount, 8.5 billion net asset acquired, I go back here. Look, preliminary fair value of FCA net assets, 8.5. This 8.5 is the difference between assets and liabilities at their fair value. Here you can see the single assets, the single liabilities, and with the fair value at the acquisition date. For all the assets and all the liabilities. Read here. Intangible assets. The brands are Jeep, Ram, Dodge, Fiat, Maserati, Alfa Romeo, and Mopar. Okay. Because PSA has acquired FCA. Now, if I go back to the annual report of FCA, so now I am in the annual report of FCA. Read the information about the brands. Chrysler, Jeep, Dodge, Ram, and Mopar. Fiat, Maserati, and Alfa Romeo were not recognized because they were internally generated. But now that PSA has bought FCA, now Fiat, Maserati, and Alfa Romeo are recognized in the consolidated financial statement of Stellantis. But Peugeot is not. Because PSA is the acquirer. So the assets of Peugeot, PSA to be more precise, they continue to remain at their accounting historical values. Is this clear? Moreover, in the 2020 annual report, Chrysler, Jeep, Dodge, Ram, and Mopar, that the total amount was 2.9 billion. Okay. This amount was the historical amount paid when, at that time, Fiat acquired Chrysler. Okay? So this 2.9 shown in the balance sheet of FCA is not the amount that now is recognized as Stellantis. Because this amount was the fair value, but at the acquisition date, when many years ago Fiat acquired the control over Chrysler. Now, so this amount that is here, the total is 12.8 billion. This is the fair value at January the 17th, 2021 of all these brands. Is this clear? This is an interesting example because since the acquisition date is very close to the end of the reporting period, and we have the balance sheet of the acquiree, it is easy to make the comparison between the two. And here there is the description on the method used in order to determine the fair value of the single assets and single liabilities. Is this clear for everybody? Any questions? I think that, I hope that this is interesting also for you, because this is a very important merge that is going to affect also our city because of the importance of not only our city but also our country. And I think that this could be a good way of analyzing how accounting principles are then applied in practice in a well-known merger, ESA and FCA Stellantis, with some particularities due to the fact that the acquirer is ESA and not FCA. Is this clear for everybody? No questions? Do you need a break? So break of 20 minutes. If I make this question, I know that the answer is always yes. You don't answer to other questions, but you answer to the question about the break. So 20 minutes, and then we start again with consolidation. Because at the end, when a parent company buys a subsidiary, it's a business combination. So 20 minutes, and then we start again.
我直接
可以暂停。
压力太大。